In today's session of Visual JForex, we will be continuing the algorithm using the indicator Butterworth. And as I had explained to you in the last session, this indicator gives us the smooth output like EMA or SMA, and we can utilize it to find the direction for the underlying instrument, whether the underlying instrument is in bearish zone or bullish side. We can decide on that and trade accordingly. So now we head to the Visual JForex board, which has been developed by the Dukascopy Bank SA. In the last session, I had completed the setup so far. This includes the instrument subscription, where the instrument of choice is Euro USD. Afterward, the position amount was defined at 0, and these Butterworth blocks have been added. But once the session was over and I was looking at the structure, I found one mistake here. This candle period needs to be of 4 hours, not 15 minutes. So I will carry out the correction, and any of you who followed last session should also do the same. So pardon me for that. Now, most part of the structure good enough, looks good enough. Okay, and I will give you a brief refresher of how we are going to set the conditions for the execution of the buy trade. We need this Butterworth output for the 4-hourly time frame to be on the rise for any buy trade to take place. We will be comparing the last 4-hourly candle output of the Butterworth to the output value 24 hours back. So we take a shift value of 6 on the 4-hourly candle period, and we compare these two outputs and see whether there is rise or not. And only if it is continuing to rise, we will consider the trade, provided the other conditions are in place. And by other condition, we have to consider the formation on the 15-minute time frame, where we will need the turnaround to have unfolded recently. We need the Butterworth indicators output to start rising after having spent some time in correction phase, and only after that happens we will be looking to initiate the trade. In first 3 hours after this turnaround happens, we will need the last 15-minute candles Butterworth output to be greater than the output 3 hours back. And since we are dealing with the 15-minute candle period, we will have to compare the last 15 minutes value with the output of 15-minute candle with a shift value of 12. And that means we go back 12 candles, 15 minutes each. So we get the data 3 hours back, and the recent one should be on the higher side, and the 3 hours back output should be lower compared to the output of the Butterworth 4 hours back. So that will get us a smooth curve like this. And after this, we need to shift our focus on the price action. We will need some correction to have happened recently, and for that the condition is going to be that last 15-minute candle should close higher after having seen the penultimate candle of 15-minute time frame close lower, that is below these Butterworth indicators. This kind of formation should be good enough provided the 4-hourly conditions are in place, and this is happening in the first 3 hours of this change in the momentum. So these are the conditions which we are going to consider to start trading. So this is the easy setup, and I hope you have been able to understand the finer points of how we are going to place the trade. So now we head back to the Visual JForex board, where we will have to start defining the conditions for the execution of the trade. And for that we are going to need a lot of if blocks. Even I am not sure how many we will need. So these two have been added. Butterworth 17, which is the output for the last 4 hourly candle, should be greater compared to Butterworth 21. First input greater than second input. With 4 hourly conditions in place, we shift our focus to the 15-minute candle period. Here, we will need the Butterworth 22nd to be higher than Butterworth 23rd. And pay attention closely here. This has a shift value of 1, and this block has a look back period of 12. So we are taking the output in at two different points of time. First input greater than second input, and this value, the Butterworth 23rd, should have been lower compared to Butterworth 24. Again, the only difference is between these shift values. Here it is 12, here it is 16. We have set the condition that Butterworth value on the 15-minute time frame for last 15-minute candle should be higher compared to the value 3 hours back, and the output value 3 hours back should have been lower compared to the Butterworth output 4 hours back. Okay, so first input less than second input. Then we have to compare how the price action has unfolded. We want to look at the closing values of get historical candles of 15 minutes each. The last 15-minute candle should have closed higher, so we need candle 25th candle close. Candle 25th, higher compared to the Butterworth output for last 15 minutes. So that is Butterworth 22nd. First input greater than second input. Then we consider the closing value of the penultimate candle of 15 minutes, and it should have closed lower, so we need candle 26 candle close and compare it with the same line Butterworth last 15-minute time frame. So this will need to have first input less than second input. Okay. And after these conditions are fulfilled, all we need to do is place the order as and when price starts to rise above the last 15-minute candle. So we have to compare these candle 27 and candle 28 closing values with the candle 25 candle close. So we are going to need one more block. And candle 27 candle close and candle 27 candle candle 28 candle close. So this needs to be added. Candle 27 has a look back period of 1. That means this is the last 10-second candle and it should have closed higher. So first input greater than second input. And candle 28 is the penultimate 10-second candle. So it should have closed lower. So in this case, it will be first input less than second input. And after that, we will add the trade command block, which will be a market order. So whatever is the current price, the trade will be executed at the current price. First input less than second input. Now let me arrange these 8 blocks on the lower side. Okay, we will also need to add multiple action block here. Logical. Here it is. For the time being, I will join it to this last candle. If need arises, we can always disconnect it and add blocks. Now coming to the input values for this block, the trade command block, we have to determine whether we want to work with a static combination or we want to consider the price action and make it dynamic. We will see how to define this. The default instrument is going to remain as it is, Euro USD. Trade amount I will change to 0.1 million. Slippage will be 2 pips. 2 pips is good enough for Euro USD. Then comes the question of stop loss and take profit. The default settings are of 25 and 50, getting you the risk reward ratio of 1:2. You can keep it as it is, or you can consider the price action and what is the formation which is likely to bring you the maximum benefit. So depending on that, you can determine the combination. Now suppose if we consider this is where the trade might have been initiated, then in this kind of scenario, I think a stop loss need not be far wide. Stop loss just a little below last 3-4 hours low should be good enough. So if we consider the price formation for last 3 hours or say 4 hours, and even if we consider the lowest value of that 4 hours to be our stop loss, that should be good enough. So let us see what is the actual difference. 1.18748 is the closing value and low is somewhere here, which is 1.18663. So that's the difference of around I guess 9 to 10 pips. 9 pips, I'm not precise here, I haven't used calculator. So 9-10 pips or maybe 15 pips should be good enough. And on the higher side, since we need to make sure that the risk reward ratio is at least 1:2, the combination should be like 10 pips to 20 pips, and let us see whether the 20 pips target might have been hit or not. So somewhere here the buying happens and it goes on to rise, but not high enough. So 20 pips target might not have been hit. Only if you were to use the setup of trail following, then maybe after the reversal happened, the trade might have been closed on the higher side above the price. So these are the technicalities, these are the minor details which you do have to pay attention to. So accordingly, you should be keeping the stop loss and take profit, and you can also carry out the changes. Suppose if you don't want to go with the dynamic, So maybe after a couple of months, you can look at the price volatility, and depending on that, you can go for a different combination. So this time around, we will work with a combination of 10 pips to 20 pips. So that is going to get us the risk reward ratio of 1 is to 2, and this is for the output value. With this, our buy side conditions have been defined. We needed 7 of these if blocks and one trade command block. So we stop here for the day. Next session, we will complete the sell side of the equation, how we can define and design the algorithm for the execution of the sell trade. That's going to be explained to you in the next session. So do come back. Before I sign off, I would also like to remind that for further market coverage, you can access our page, the Dukascopy Analytics page. And whenever you want to start trading, if you haven't already, you can use the JForex platform to get acquainted and start trading in the market. We are also available on the Facebook. You can follow our page there. Thank you all for joining in. See you next time. Till then, goodbye.